Good morning, hunters. Welcome back to the Daily Hunt for Multi-Baggers on this Tuesday, January 13th, 2026. We've got a busy one today, sifting through a truly significant number of social media posts from yesterday, January 12th.
That's right, Ethan. It was an active day. We flagged a diverse range of companies, from mega caps grappling with strategic shifts to some intriguing microcap plays. Overall, the sentiment out there is a real mix, offering both promising signals and, well, some definite red flags we need to talk about.
All right, let's dive straight in, starting with Warner Bros. Discovery, symbol WBD. There's so much chatter around this one, Brooke, with Paramount making a hostile takeover attempt at $30 a share and WBD pushing a Netflix deal. I mean, the drama alone has people talking, and that $30 offer is right there, just above where it's trading. That kind of action can really get a stock moving, you know?
It certainly creates buzz, Ethan, but let's pump the brakes a bit on the excitement. The current price of $28.40 is already super close to that $30 offer, meaning a lot of that potential upside is, well, already priced in. And from a KPI perspective, WBD has an extremely high price-to-earnings ratio of nearly 150. Its net profit margin is a meager 1.2%, and revenue growth is actually negative at negative 0.06. Users are openly questioning Paramount's financing, suggesting it could saddle WBD with even more debt. We're talking about a debt-to-equity ratio that's already sitting high at almost 90. That's a lot of financial pressure, regardless of the deal. But the market's been optimistic, Brooke. It's gone from $9 to almost $29 in the past year, clearly riding on these acquisition waves. There's still potential for a bump if a deal does go through cleanly, especially if it leads to real value creation. Potential, sure, but it's laden with uncertainty. Lawsuits, proxy fights, skepticism about the true cash nature of Paramount's offer. If these deals unravel, those weak fundamentals will be the only thing left, and that $30 price could look, as one user said, ludicrous. Given its past ratings of lean towards stay away or speculative gamble, our AI-generated insights suggest for now, WBD is a stay away.
Okay, fair enough. Next up, we have rocket companies, RKT. Now, this is exciting. We're seeing massive insider buying here, over 200% of shares purchased by insiders in recent months. That tells me the people closest to the company are seeing something big on the horizon. Plus, social media is buzzing about a potential $200 billion mortgage bond purchase plan from a former president, which directly sent RKT stock soaring. One user, who's already made millions, called it my NVDA Plat TR and expects it in the high 20s next year. Ethan, that insider buying is definitely a compelling data point, I'll give you that. And yes, the policy news has created a significant surge. However, let's not overlook the current financial health. RKT's net profit margin is negative, and so is its earnings per share. It's currently losing money, and the debt-to-equity ratio is a staggering 251.4%, indicating massive leverage. While the proposed mortgage plan could significantly boost revenue and profitability down the line, these are serious risks to consider. It's a highly volatile stock with a beta of almost 2.3. True, it's volatile, but the revenue growth is positive, and the insider conviction, coupled with a direct, massive industry catalyst like that mortgage plan, suggests a strong turnaround is not just possible, but expected by those in the know. We've previously flagged RKT as a stay away, but with this new information, especially the insider activity and policy tailwind, this is a clear upgrade. Based on this AI-generated analysis, RKT is a buy.
Let's turn to Chemours company, CC. Now, a quick note here. The social media mentions of CC were actually referring to covered calls for option trading, not the company itself. So we're relying solely on the financial data here, and it's quite stark.
Yeah, no user sentiment for the actual company, which is a bit of a void. But I've seen some news about institutional funds making big bets, even a recent 17.5% weekly share price increase, and there was a minor insider purchase of shares. Could this be a deep value play that smart money is starting to sniff out? If it is, Ethan, it's a very risky one. Its debt-to-equity ratio is an astronomical 1,473.0. That's not just high, it's severely distressed. On top of that, its net profit margin is negative, and so is its earnings per share. The company is actively losing money, and revenue growth is slightly negative. It's also trading 80% below its 2017 highs and facing ongoing litigation concerns. JP Morgan even lowered its price target. While a few funds might be making speculative bets, those fundamental KPIs are screaming danger. This one has consistently been a stay away in our previous analyses, and that hasn't changed. Our AI-generated insights classify CC as a stay away.
Okay, next up is Meta Platforms, Meta. This one had the highest post count today, over 100 posts. The big news is the 10% layoffs in Reality Labs. This is exactly what Brooke and I have been talking about, pruning the money pit and focusing on efficiency. Plus, Meta is making huge investments in AI infrastructure, launching a Meta Compute unit.
And get this, insiders have been aggressively buying, with net shares purchased at over 146%. That's a massive vote of confidence internally, indicating they believe the stock is undervalued despite what the public thinks. I appreciate the optimism, Ethan, but the sentiment on social media is overwhelmingly bearish. Users are calling Reality Labs a money pit and Meta a garbage stock that sinks like the Titanic. They're saying these layoffs are not enough and too late. The stock is trading significantly below its 52-week high, and while its revenue growth and profit margins are strong, that high PE ratio around 28-29 means high expectations, and right now, the market sentiment isn't rewarding those strong fundamentals. The stock is sinking as the market gains, according to recent headlines. The insider buying is certainly a strong countersignal, but public perception is a powerful force. This stock has seen many ups and downs in our ratings, most recently being a buy, but the current bearish sentiment is too strong to ignore right now. Based on today's AI-generated market commentary, Meta is a stay away. Right, moving on to Envirotech Vehicles, EVTV. This is pure excitement, Brooke. The stock was up almost 196% recently on massive volume. And the big news is a transformational merger framework with AZI AI, establishing a reference value of $3 per EVTV share. The current price is $2.51, so there's clear upside to that. Plus, AZI AI has already secured $100 million in government purchase orders and has a $200 million regional pipeline. This sounds like a fantastic growth story about to unfold.
Ethan, that's quite the narrative, but my KPIs are flashing red, deep red. EVTV has an earnings per share of negative $57.40. That is extraordinarily unprofitable. Its debt-to-equity ratio is extremely high at over 213%. This is a microcap company with a history of extreme volatility, bouncing between 33 cents and $11.50 in the last year. While the merger could be transformational, it's reliant on future execution and profitability that simply isn't present in its current financials. This isn't a growth story yet. It's pure speculation on a struggling company. It's the first time we've rated EDTV, and our AI-generated analysis suggests EVTV is a stay away.
Last but not least, let's talk about Apple, AAPL. Always a solid performer and still innovating. We're seeing reports of the new iPhone 17e coming in February 2026 with an even more powerful A19 chip, boasting 5 to 10% better CPU performance. Apple is also making huge strategic moves by integrating Google's Gemini AI into Siri. This company is constantly evolving, keeping its competitive edge, and news suggests strong fiscal Q1 performance on iPhone sales. This continuous innovation and strategic AI play will drive future growth, I believe.
I agree that Apple is an innovation powerhouse, Ethan. Their revenue growth is solid at nearly 8%, and their net profit margin is excellent at almost 27%. However, these strengths come with a premium. Its price-to-earnings ratio is nearly 35, and its price-to-book ratio is over 52. These are very high valuations, meaning investors are already pricing in a lot of future growth. While new iPhones and AI integration are positive, the question is how much more upside is there from these already highly anticipated developments? Can it truly exceed those high expectations to justify the current valuation? Previously, Apple has been a bit mixed in our ratings, sometimes a stay away, but the consistent innovation and strategic AI plays do indicate sustained long-term growth. Our AI-generated insights classify AAPL as a buy.
All right, let's wrap up our hunt for today. Brooke and I have put together our AI-generated list of top candidates for your own deeper research. Investigate as buy. Rocket Companies, Inc., Apple, Inc. Investigate as cautious buy, none. Investigate as speculative gamble, Envirotech Vehicles, Inc.
And that brings us to the end of today's Daily Hunt. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for tuning in, everyone. We'll be back tomorrow with more AI-generated market insights for your journey to finding those multi-baggers.
Until then, happy hunting.